In this presentation, we're going to look at convertible debt. That is debt swapped for equity. And we're going to specifically be looking at convertible bonds here. And we're going to be using the residual or incremental method for valuing these bonds and recording them on our balance sheet here. So what we're going to be doing here is we're going to allocate this bond value between the liability portion that it represents on the balance sheet and the equity portion that it represents on our balance sheet, since it is really both a liability and an equity. All right, let's go through our example here, and we're going to start out here when the bonds are issued. So we get a 5-year, $100,000, 7% convertible bond, and you can convert each bond into 25 shares of common stock. And the current market value of those stocks are $3.50 per share. So the first thing we have to do here is we have to determine the liability portion of that bond. And we do that by taking a similar bond without the conversion feature, and we would discount it back to its present value today. So for the example here, I took that similar bond and I discounted it back here to $96,150. That's its present value. So we'd increase our bonds payable amount by that amount here. Now, we have to calculate the equity portion that we have to assign to that bond. And we do that by taking the bond's par value amount here, and in this case it would be $100,000, or we debit cash for that amount here as our asset. And then to determine the equity portion here, and in this case it would be in a surplus account, and it would be the conversion rights of those bonds. And we would do that by taking the par value of the bond less its liability portion here, and the difference here would be, in this case, would be $3,850. We'd credit our additional paid-in capital for $3,850. So here we assigned the debt portion of our bond liability here, and also our equity portion of our bond liability. Okay, let's look at a conversion before maturity of these convertible bonds. So what we're doing here is we're swapping this debt here for equity. We're going to exchange these bonds here for stock. And what we have to use is a method consistent when the bonds were first recorded. And that was our residual or incremental method. So first thing we have to do here is we have to go down and we have to determine the carrying value of that convertible bond at the time of the conversion. So in this case, I'm showing here a $98,652 carrying value of that convertible bond. So we go up here to our bonds payable account, and we debit it, or we'd or decrease it here by that carrying value amount of those convertible bonds. Then the next thing that we'd have to do here is we'd have to take the surplus account here for these conversion rights. I had it put in as additional paid-in capital, and we'd have to close that out because they no longer exist here. And then the balancing amount here would go into the common stock account here, where we traded here these bonds payable for common stock. And that common stock account here would be based on the bond's carrying value plus those conversion rights. And that, you can see, was $102,502 here. All right, let's look at an induced conversion of these convertible bonds. And this is where we're going to pay our bondholders an extra amount of cash to convert these bonds into common stock. So the first thing we have to do is we have to determine the carrying value of these bonds at their conversion date. And I did that down here. So we would debit or reduce our bonds payable account by that amount here. And then we'd also close out this surplus account here for those conversion rights. Then the next thing we'd have to do is we'd have to reduce our cash account by the amount of that extra premium we paid to those bondholders. In this case, it was $1,500. So we have to go down here to record an expense for that debt retirement, and that's part of our net income on our income statement here. So to do that, we had to determine those bonds' fair value at the time of conversion, those convertible bonds' fair value. And I just use an example here of $98,400. That was their fair value. And then we would subtract the bond's carrying value that we had over here, and In this case, I come up with $553 as an expense, or we increased our expense here for the debt retirement of those bonds. Then we go up here to the retained earnings, and that's really the difference here between this cash amount that we paid to the bondholders and the expense that we recognized here. So that was the difference here between $1,500 over here and the $553 worth of expense, and that was for $947. So the next thing we have to do is we have to determine the balance here in this common stock. That was the amount of common stock that we'd have to record for that bond swap here. And that's really a balancing entry here, where we take all these debit amounts that we had in bonds payable and the surplus account here and the expense account, and then our retained earnings. And then we'd subtract out our cash amount here, that credit to cash. And we'd come up here with a credit balance in this common stock. And in this case, it was $101,697. All right, let's look how we'd retire this debt before maturity, where we would not exchange common stock for the bonds. All we'd pay is our bondholders a cash amount to retire these bonds. So the first thing we have to do is go down here and determine the carrying value of those bonds at the retirement date. So we debit our bonds payable or reduce it by that carrying value amount of those bonds. Then we'd also close out this surplus account here for those conversion rights. And then going up here to our cash account, we'd decrease that by the amount that we paid to our bondholders to retire those bonds here. And that was for $107,000. Now we'd also go down here and record a debt retirement cost here, an expense, which is part of net income on the income statement here. And that again is based on the bond's fair value. We'd have to determine the fair value of those bonds at the retirement date here. And then we would subtract the bond's carrying value and to determine that expense here for the debt retirement of those bonds. Then we go up here to retained earnings, and that's really a balance account here between our debits and credits here. So we would have a debits here in bonds payable, additional paid in cash here, and this expense here, plus this retained earnings. And that has to balance with the cash that we paid to retire those bonds. Okay, in review, you're going to have to be able to determine the carrying value of these convertible bonds at their conversion or retirement date. And you're also going to have to be able to determine the bond's fair market value at the date of issue, and also when we do the retirement here or the conversion here, so we can determine the debt retirement cost. And also, you just remember we're using the residual incremental method. So when you first issue the bond and then your retirements or conversions thereafter, you got to continue on with the same method. Now, you can go through this video here and look at the journal entries, and just remember they're laid out here where you've got the assets equal liabilities and equal plus the stockholders' equity, plus you have your net income shown over here. So these are laid out in T account form, and then you've got them shown here as your balance sheet items and then your income statement items.